In the previous video, we discussed the default loss for a single obligor. Now let's talk about the default loss for a portfolio, which is what really matters to a financial institution like a bank, which will have a portfolio not of one single loan, but a portfolio of many loans. So what the bank is worried about is the default loss on the overall portfolio. So the definition is here. The default loss on a portfolio is just the sum of the default losses across all the obligors, the companies to which the bank has lended money. And if you recall from the previous expression when we started this section here, the default loss for each obligor is given by this product of these three variables that we have just discussed in the previous video. Okay? So let's see how this default loss typically looks like. What is the distribution? So empirically, what we observe is that the distribution of default loss for a portfolio, what you see here, typically has this shape. So 0 is the limit on the left, and this is the good case in the sense that we are losing 0 here. As we move to the right, this becomes worse and worse and worse for the bank. These are bad scenarios in the sense that here we are losing a lot of money. So what, again, the shape we observe is something like this, and what is striking here is that the right tail is very heavy. What this means is that in practice there will be circumstances, scenarios where the loss is very big. We'll discuss this in more detail when we get to the portfolio models, but essentially this comes from the fact that losses are correlated between firms. So in a recession, for example, you will see a lot of firms defaulting at the same time, and that is bad for the bank that is lending money because they will observe a lot of losses in their portfolio. So there are two important concepts in this distribution. One is the expected value or the expected loss. First, let's compute the expected loss at the individual level first. So let's compute the expectation of that function for the default loss of a single obligor that we started with, talking about in this section of the handouts. So if you recall, this D here was N times E times L. If we assume that the E and L are fixed, that are known, that are constants, then it is just the expectation of N. And the expectation of N is just the probability of default. Right? So we put here the probability of default. Look at these numbers here at home and make sure that you can understand what's going on here. At the portfolio level, which is what we are talking about now, the expected loss at the portfolio level is just the sum of the individual expected losses, right? So this term here is this expression that we have up here. And we just sum the same, we sum the expected loss for each obligor. Quick example here, this is the smallest portfolio you can think of, just 2 loans. So this I here is just 2. But it's enough to illustrate how this works. If go through these numbers at home and make sure that if you use these values that you see here, so loan A, plug in this exposure, this probability of default, the recovery rate is 40, therefore the LGD is 60. Multiply these 3 numbers, this times 60, then plus this second line, and make sure that you get this final number here, right? So more than the numbers now, what is important here is the concept. The expected loss on a portfolio, as the name suggests, is something that you expect to happen. It's not bad luck, it's expected. And what does that mean? It means that the loans should be priced according to that. In other words, the spread that a bank charges on a loan should be enough to compensate for the fact that, on average, some of the loans will default, right? And this idea is very similar to insurance, to the way an insurance company prices their products, right? So the premiums they collect are enough to pay for a few car crashes, okay? The second concept that is important here is the unexpected loss. So this, again, as the name suggests, this is the part that is after the expected. So this is not something that we are counting on, but it still may happen. It is defined by difference between the expected loss we just discussed and a critical value. So this critical value will be computed through the models we will discuss when we get to portfolio models. So this is like this is a value at risk type of value. So it's a loss that is very big. We only expect it to be reached in a very extreme scenario. So for example, we may define a critical value at the 99% confidence level, meaning that only in 1% of the cases do we expect to get a loss that big or higher. Right? So this is this decomposition between expected and unexpected loss is important. Let me open a figure here. This is not in the handouts, but I will post this in Moodle. So what I have here, it's again this distribution of the portfolio loss, the same figure you had up there. We defined the expected loss as something here that is expected. So this part here, this part of the loss from here to here should be priced, should be the spreads that the bank charges on the loans should be such that the bank will be able to support this expected loss. But then there is this additional part of the loss which goes from here to here, this unexpected loss, that goes from the expected value to the critical VAR value, that is not priced. The way banks manage this risk is through capital buffers. So that's why there is supervision of banks requiring them to have capital reserves, right? To be able to sustain these types of losses, which are not day-to-day losses, they are not expected, but they happen in some cases, and when they do, the bank has to be able to survive. They have to have capital to withstand these losses. Okay? The bank management can decide what is the level of capital that they want to have. So if they want to have, if they want to be very safe, if they want to have a very good credit rating, they can decide to have capital reserves to withstand a very high loss, some number here to the right. So to some extent, the bank manager can decide whether to have a safer or less safe bank. If the loss is extremely severe, so if it goes to the right of this, if it is very high, then the bank will default. Okay? And let's see what happens during this current crisis. I'm sure we will be talking a lot about defaults very soon in the coming weeks. All right, that's the end of the video. See you later.